Hey everyone, in this video I've got one growth stock that's down 66% off the high that I think you can buy now in March and even further beyond that. So without further ado, let's jump in. Let's take a look at what this growth stock is and why I'm recommending it as a buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, the growth stock I'm talking about in this video is Sofi Technologies, which is down 66% off the high it reached in 2021. The online bank is doing an incredible job attracting customers and deposits, and I think it's gotten further enough along in its profitability prospects that it makes an excellent investment now. So I was never concerned with SoFi's revenue growth. It had been growing revenue nicely. The area I was concerned with was profitability, and I mentioned it's made great progress there. I'll talk a little bit more about that a little later in the video. But looking at revenue growth, 2.108 billion in trailing 12-month revenue. That's up from roughly 700 million about two and a half years ago. So it's nearly tripled its revenue, and it's done an even better job attracting customers. The company offers an industry-leading APY for deposits for its bank. So customers that join in, they can get 5.1 even, I've heard at some points when interest rates were even higher on their deposits in the bank. So if you compare that with, let's say, Bank of America, where you're getting nothing for keeping your money there on checking. So it makes it an attractive choice for customers looking at somewhere where they can actually earn some money on their checking account where their money is being stored. It'll at least earn some money, and 5% is reasonable. It's enough that it's attracted plenty of customers over to SoFi. And the digital banking offer used to be a big competitive disadvantage. Let's say 5 years ago, maybe 8 years ago, if you didn't have physical presence in local cities, it made customers hesitant to join your bank because people used to utilize that service much more often, where they would walk into the bank and conduct banking in person, whether it be depositing cash, depositing or cashing checks. Various activities were done in person more often. Nowadays, that's less the case, right? Now, the mobile checking deposit has increased in effectiveness enough so where if you're not getting your work checks deposited directly in your checking account and you're getting paychecks, you can still go onto the banking app and deposit the check via your mobile phone. And that takes away one last use case where people needed to visit the physical branches for checking. Now, with that being, for the most part, eliminated as a reason to want physical branches, customers are opting not to visit these branches as often. And so a digital bank, an online bank like SoFi, can save on that expense where it doesn't need to invest in all those locations and thereby offer customers better checking rates, better rates on deposit. So it can spend that money giving it to customers as an incentive to join the bank. This strategy is more effective today than it would have been 5 years ago because of those reasons I mentioned, and SoFi is gaining wonderful traction in that regard. And then I mentioned profitability, that we were going to discuss it. In the latest quarter, SoFi Technologies reaching profitability on the bottom line for the first time. Net income of 47.91 million, and management saying that from now on they are going to be net profitable. Management gave this guidance earlier in 2023, stating that they would be profitable by the fourth quarter, and they hit that target. I always give management credit for setting a target and hitting the target when they do that. When they set a target ahead of time and they hit the target, I give them credit for that kind of ability. Many companies set targets and then don't hit them, or delay the target, or extend the target, right? When a management team hits a target, I give them credit, and the more they do it, the more credit they get. And so now that SoFi has hit this target, they set even more ambitious plans for the future. So management is suggesting they will achieve full year GAAP net income in fiscal year 2024 of between 95 and 105 million. That would be roughly 100 million at the midpoint, with earnings per share of between 7 cents and 8 cents. More impressively, they're going to do that with lending revenue between 92 and 95% of 2023 levels. And what that means is they're decreasing lending. And to increase your profitability while decreasing lending is impressive. You're lowering the risk profile of the business while increasing profitability. Management said they're doing this purposefully because they anticipate a slowing economy in 2024. And for a bank, a slowing economy is extra dangerous because most of your business is in lending. And if you have loans outstanding and the economy is slowing, that means people are losing their jobs or they're making less income. And if they're making less income, one of the areas they may not be able to fulfill is paying back their loans. And if they're not paying back their loans, then SoFi is losing money, right? You've let people borrow money. You're expecting them to pay you back. If they don't pay you back, then that's money that you lost. And so that's a risk. That's a big risk when you're investing in a bank. And SoFi is exposed to that risk. And so I'm impressed that they're going to grow profitability while at the same time being more prudent with lending because of the slowing economy. They want to kind of pull back. It's not that much of a pullback, right? 92 to 95. So that means roughly 5 to 8% decrease in lending in 2024 versus 2023, right? So it's not a massive pullback, but a moderate decrease just to kind of lower risk. And I think that's a good decision here from SoFi management. And looking beyond 2024, management expects 20 to 25% compound revenue growth from 2023 to 2026. And that's expected to drive profitability, earnings per share, to between 55 cents and 80 cents in 2026. So in 2024, earnings per share, let's say 7 cents, and then in 2026 between 55 and 80 cents. So a multiple expansion in profitability over the next 2 years. So from 7 cents to, let's say, at the midpoint 65 cents or 70 cents, just so we can say that it's 10 times more in 2 years, right? Rough estimates here, but the company expects its earnings per share to grow from 2024 to 2026 roughly 10 times. That's huge increases in profitability from a company that just now received profitability on the bottom line. And then beyond that, they see 20 to 25% earnings per share growth even beyond 2026. So they do expect robust profitability going forward for the next several years. And I like that when I'm looking at an investment is robust earnings per share forecasts going forward, not just revenue growth, right? I'm not as excited about revenue growth as I am about profit growth. And what SoFi is talking about here is profit growth. For the longest time, they were talking about revenue growth, right? And I wasn't that excited about SoFi stock back when it was only talking about revenue growth. But now that it's talking profits, it has me excited and it has me recommending SoFi stock as a buy. And finally, the stock is not incredibly expensive when you're thinking about that level of earnings per share growth. You're able to buy SoFi stock at a forward price to earnings of 27.89, which I think is a good deal when you're getting this kind of earnings per share growth. I think this is a good valuation to pay. So for all these reasons, I think SoFi stock is one that's down big that you can buy now in March. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.